think by and large, the clients are trying to look not through, but beyond the war. I think there's a sense that we've been hit by shocks coming out of the U.S. and at some point they end, and then life, resumes. Well, at some point they end, good or bad. But and so there's an intense desire to not get waylaid by the noise and the constant the shocks that resolve themselves and focus on what's really happening in the underlying economy. And the answer is, well, there's a lot of really interesting transformation. There's the AI story, there's the supply chain rewiring story, there's a defense story. So there's actually quite a lot of engines of resilience there.
Earnings season is kicking into high gear this week. We've got about 20% of the S&P 500 companies going to report, including some big names, Tesla, Boeing, Intel, GE, the list goes on. Isabelle, how much are earnings driving the performance for equities at the moment?
A lot. I think, I was in Washington, D.C. last week for the IMF meetings, and a lot of the conversation was around the apparent disconnect between how stock markets have performed. I mean, we're above where we were at the start of the war in U.S. markets today versus this really enormous uncertainty about the war and the impact it's going to have on the economy. And I think the reason for that is exactly earnings, which so far have been very strong. Earnings expectations have been revised up, not down. And I think this is, again, an indication that people think the damage from the war is going to be contained.
Including companies, if they're revising upward.
Including companies. The problem with that is that it's not a certainty. It's just a bet that people have obviously confidence in. And that was also the mood, last week in Washington. But what I would say is that people from the region were the ones sounding a note of caution of saying, look, this is going to be complicated. Even if a peace deal is signed today, it's going to take a while for things to normalize. And so, maybe hold your horses, all of you out there who are bullish. But for now, this bullishness, I think, dominates.
Isabelle, when this war started, I think the economic concerns, given the shock that we've seen to the energy space, would be perhaps slower economic growth, higher inflation. Have you adjusted your numbers at all to reflect that, or what are you seeing out there?
So we're waiting for the ceasefire to publish our new numbers. And it's been a bit of a moving target. But yes, the direction of travel, I think it's hard to argue with this. Growth revised lower, inflation revised higher. The quantum is what we're still waiting to see. But, by and large, we're very aligned with the IMF numbers and others, which is, we were starting from a position of strength with fairly good growth momentum everywhere. And that growth momentum is going to be slower. But, we're not looking at a recession, again, unless things re-escalate in the Gulf. And the inflation shock is going to be meaningful, but not something that would require central banks to, hike interest rates by as much as they did in 2022.
I want to ask about the disconnect between Europe and U.S. traders, because I'm looking at the WEI screen here on the terminal showing me year-to-date percentages for the major indexes. S&P 500 up 4% year-to-date. The DAX in Germany down about 1/3%. So are European investors seeing this war and its implications differently than the way U.S. investors are?
So I think it's just a reality of the components of the respective stock markets. The U.S. stock market is tech-heavy, and the U.S. economy in general is less exposed to this energy shock, just because, U.S. is a net energy exporter. Germany, out of all the European economies, is the most industrial and the most, carbon energy intensive. So yes, it is going to be hit disproportionately. And that's what you see in the performance of the DAX that you just mentioned. But everything considered, being down, what did you say, 0.25%, is a bit of a shrug, frankly, compared to what could be the scale of the shock. So I think it's telling you that even in Europe, and that's definitely true in Germany, there is a lot of resilience. And there are a lot of other drivers of growth, notably the infrastructure and defense public investment effort that is underway in Germany that is going to continue to power growth through this shock.
That's kind of where I wanted to go, is about the positive economic development starting last year from the tariffs of investment on the part of Germany and maybe even some other European countries in defense, in just infrastructure. Now that's got that offset a little bit, which is, boy, the higher energy costs here. So what's the economic outlook broadly defined for Europe right now?
So look, we were expecting Europe to grow at around 1.5% before the war. We're going to revise that down by exactly how much I can't tell you, but we'll still be, roughly around 1%. And that's because there are these other drivers of growth. Investment in the energy transition was already there. I would expect this will accelerate. And then there's also a lot of investment into tech modernization. Some of it is AI, some of it is more plain vanilla automation. But all of that has to continue. This is what we're hearing from our clients in the real economy, and that's going to be a factor of resilience.
And do your clients see the U.S. dollar as still sort of the gold standard of safety, safe haven assets?
Well, I think you know the answer in the way you asked the question. So it's not been the gold standard ever since 1973, was it? But no, I think it's fair to say that looking at the behavior of both the dollar and U.S. Treasuries in these recent market wobbles, it's very clear that while they retain a lot of reasons to feature in portfolios, they're not the all-weather risk hedge that they once were. And so people are looking to diversify from the dollar as a safe haven and to find other ways to introduce safety in their portfolios. And interestingly, and that's something, again, I heard a lot around Washington last week, this is creating appetite for European assets and for certain emerging market assets.